Let me give you a really common situation that we see every single day. A family had worked in Canada for 10, 20, sometimes even 30 years. They moved to the States and they're now planning on retiring here in the States. The only problem is they still have all of these retirement accounts still up in Canada, a lot of times not doing anything for them. And now that they're close to or in retirement, they need to figure out, how do we actually get that money? How do we actually use that for retirement? If that's your situation, this video is for you. Hello, my name is Brian Haggard. I'm the founder of RetireMitten Financial. We help simplify your cross-border retirement. Today, we're going to talk about a few things in regards to your Canadian retirement accounts. We're going to talk about some of the basics around what do taxes look like when you're withdrawing money from your Canadian retirement accounts. We're going to talk about the two main types of Canadian accounts that we see here in the US, the RRSP and the LIRA account. And then we're going to put it all together and talk about some different strategies that you may consider as a US resident with Canadian retirement accounts. First of all, I want to address taxation and here in the US and your Canadian retirement accounts. I have really good news for you. A lot of people are very concerned that when they start taking money out of their Canadian retirement accounts, they're going to have to start paying Canadian taxes again, filing Canadian taxes again. You know how much of a pain that can be. Well, good news for you. In all likelihood, you are not going to have to file Canadian tax returns just because you're taking money out of like an RRSP or a LIRA. There may be some reasons to still do it, but 99% of our clients do not file Canadian tax returns just simply because of those accounts. Now, that doesn't mean you're not paying taxes on that money. You are. So a couple things. First and foremost, if you withdraw money from a Canadian retirement account, Canada will withhold some of that money for taxes. And that money is essentially gone. But the nice thing is Canada says, hey, we're good. You don't have to file taxes. We've got our money already. Now, we're not done there, unfortunately. As a Canadian resident, as a US resident, you still have to file taxes on your Canadian income. You still have to claim that on your US taxes. Now, the good news is the money that you've paid Canada already in the form of that tax withholding, that will help offset those taxes that you have here in the United States. And we'll talk about what that withholding is for the various accounts that you may have. Let's start off by talking about your RRSP, your Registered Retirement Savings Plan. That is the retirement account that we see most often here for Canadians living in the US. The nice thing about the RRSP is it's pretty flexible. You can take out as much or as little from the RRSP as you want on a year-to-year basis. There's no early withdrawal penalties like there is on US retirement accounts. You can take out $5, $10, $15, $25,000. It really doesn't matter. It's a very flexible plan until you hit age 72. And then at that point, there's some required withdrawals that you have to start taking out. But prior to that, it's pretty flexible. The negative, though, of the RRSP is if you take money out of it, there is a 25% withholding tax done by Canada. And so, like, for example, if you were to take $10,000 out of an RRSP, Canada would withhold $2,500, 25% of that. You would get the rest of that money. And then, like I mentioned to you, then you would then be able to include that on you'd have to include that on your US taxes and still pay US taxes on it, but that 25% would go towards those US taxes so that you aren't necessarily double taxed. So one option with your RRSP is just to take the money directly out of the RRSP. The negative of that is that you have 25% tax withholding. Another option that you have with your RRSP is to convert your RRSP or collapse it in what's called an RIF, Retirement Income Fund. The big benefit of converting your RRSP to an RIF for US residents is that it reduces the tax withholding from 25% all the way down into 15%. And that's very desirable for a lot of US residents who are paying a little bit less taxes, especially if you're already in retirement, that's less withholding, less taxes that you're typically ultimately paying. Now, there's one negative of converting your RSP to your RIF, is that in order to get that withholding down to 15%, you only can take out up to 10% of your account value per year and maintain that 15% withholding. So it's not as flexible, right? The year in which we convert, or the year after we convert the RSP to an RIF, we have to start taking money out, and we can only take out a certain percentage each year to maintain that 15% withholding. Now, one other note about the RSP is if you're 71, or the year in which you turn 71, you're forced to convert your RSP into a RIF. And then at 72 is when you're forced to start taking that money out tonight. The other Canadian retirement account that we see very often here is like a LIRA, or a locked-in retirement account. And unfortunately, locked-in retirement accounts are a little bit more complicated because they're much more restrictive than an RRSP. You typically aren't able to just take out a little bit of your LIRA account every year. You essentially have what we tend to find are two options with your LIRA account as a U.S. resident. One option as a U.S. resident is that you can take the full amount all at once. You have a one-time opportunity to withdraw all of your LIRA account and be done with it. Now, again, the negative of doing that is higher tax withholding. The withholding is 25% instead of 15% that you may have as we talk about the other option that you have. So you do have a one-time opportunity to withdraw the full LIRA. The other opportunity that you have with the LIRA is to convert it into what's called a LIF, a lifetime income fund. And again, like an RIF, the big benefit of the LIF, the LIF, is instead of having 25% withheld from the full LIRA withdrawal, there's only 15% withheld from Canada. So there's typically less taxes paid on the LIF, but the LIF is very restrictive. You're only able to take out a maximum amount every year. Typically, I see that maximum amount to be 6-7%. So for the most part, you're going to have that LIF account forever. And so if your LIRA account is smaller, you may not want to convert that to a LIF and only get a couple $100 or a couple $1,000 a year. You may want to just take the full amount out and be done with it. All right, so let's put it all together. We talked about the RRSP withdrawals. We talked about RIF withdrawals, LIRA withdrawals, LIF withdrawals, right? You have some different options here, but let's talk about a few strategies that we typically will implement with our clients. One strategy is just to take it all out at once, right? Just get rid of that RSP, just get rid of that LIRA, withdraw it all and move it down to the US. A lot of times folks have had their money up in Canada for 20, 30 years, not doing anything. Maybe they're smaller accounts and they just want it out of there. They want to move it down to the States. Now, the negative of doing that is, yes, there's going to probably be 25% withholding on your withdrawals, but you're done with it. It might save you on tax forms, filing on a year-to-year basis. You don't have to worry about trying to invest the money up there. You can just be done, right? The second option is to do nothing, right? We have some clients that are in retirement are really focused on tax strategies such as Roth conversions or other strategies, maybe drawing down taxable assets to take advantage of capital gain income tax rates, right? So you don't have to do anything. At 71, you will eventually be forced to do something, but you're not required to do anything in the meantime. Maybe you want to wait until the exchange rate gets a little bit better, and then at that point, just withdraw the full amount and bring it down to the US, especially if you don't have any Canadian ties. And then the third option, and I would say it's probably the option that we implement the most often for our clients, is we convert your RSP to an RIF, we convert your LIRA into an LIF, and we start those annual withdrawals. The benefit of that is, by taking the money out of the RIF and the LIF, we have the lowest tax withholding, right? It's only 15% tax withholding as opposed to the 25% from the RSP or the LIRA. So it tends to be a little bit better tax-wise. The negative is that in all likelihood, that money's going to be up in Canada for a long time. So for those of you that kind of struggle with having that money up there, they don't have an advisor up there, they don't have a way to make investment decisions, unfortunately, that money is going to probably be up there for a long time by implementing that third strategy of, converting it to a RIF or converting it to a LIF. But again, it's probably the strategy that we see most often. As I mentioned before, here at RetireMitten Financial, we specialize in cross-border planning. And so if you're interested in working with somebody to create a retirement income plan, a cross-border tax strategy, please give us a call, or on our website, RetireMitten.com. There's a link in which you can schedule a complimentary consultation, and we'll talk to you about our services and what we provide. Please, all information that we've talked about today should be education only. There can be some easy ways to kind of get yourself in trouble with cross-border planning. So we do really suggest talking with a cross-border financial planner or cross-border tax preparer to help you with some of these decisions. Thank you.